Hi, it's Arjun. For the past month or so, we have been pushing back on the oil glut narrative and the pervasive oil gloom that has existed really since Liberation Day in early April, when people started worrying about oil demand, which of course coincided with the accelerated unwind of OPEC quota cuts and therefore concerns about supply as well. And look, it's September 25th that we're recording this. Another week has gone by, and again, we are now, no oil glut yet. We're going to knock on wood. We are now nearly through the end of September. We're well past the summer driving season, well ahead of the winter demand season. We're in classically the fall shoulder months when you have refinery run cuts. And this is the environment where when you have oversupply, you usually start seeing in the price. Now, I think we're expecting further refinery maintenance and run cuts in October. So I do think we still need to get through maybe the next 4, 5, 6 weeks and so forth. But at least so far, while we do anticipate some softness, that oil glut narrative of multiple millions of barrels a day of oversupply, we think that call is way off base, and at least so far is not on track to come through. This week, we wanted to check in on where traditional energy stands on the terms of growth and profitability. And we've long said that is what drives energy equities and, frankly, all equities. What's your outlook for growth? What's your outlook for profitability or returns? And for those of you that are not equity analysts, when we say returns and profitability, we mean metrics like cash on cash returns, return on capital, sort of the corporate or sector level profitability metrics is what we're talking about. And we contrast our view that it is always about growth and returns with a little bit of what we're hearing as the blame game of, certain leading macro agencies have unfavorable narratives, or ESG's been out there, or it's environmental activists, what have you. It is always about growth and returns, and that is our focus. And we frankly have had now a 2.5 year period since kind of the peak of the oil price move after Russia invaded Ukraine, the peak after that, kind of a couple quarters after that. It's now been a 2 to 2.5 year negative EPS revision trend. Returns on capital have eroded from those high levels in the middle of 2022. And so unsurprisingly, I would say the sector has struggled in the face of that. We have two key messages for this week. The first is we believe we are now much closer to trough than we were to peak 2 to 2.5 years ago following this mini down cycle. Things could always get a little bit worse. There'll be a million caveats we should make when we say that. But we think we are certainly under-earning as a sector, and that profitability is now below normal. And that's a good sign in a cyclical business to be thinking that we are closer to trough than to peak. The second key point is, as a result of where current profitability is, again, I think the sector is slightly under-earning right now. And where we think profitability is headed, again, we think we're in a multi-year structurally better period for profitability. We believe energy should close the gap between its current discounted 3% S&P weighting and what is about a 5% earnings weighting in the S&P 500. Based on where returns are, where we think they're headed, that gap between the market cap and the earnings weight should close, in our opinion, in favor of meeting the earnings weighting. It remains our view that 2020 marked the bottom of what had been kind of a 10 to 12 year structural down cycle in profitability, and that a new structural upcycle in returns on capital, in cash on cash returns and profitability began in 2020. That was the bottom. And depending on which you count as the start date, it's either year 4 or year 5, or what should be at least a decade plus kind of trend. And we reiterate our longstanding call that by the time we get to the end of this sort of structurally better period of profitability, energy's S&P weighting will normalize back to its historic 8 to 10% band. That view is getting tested right now following the 2 to 10 year downturn, and we want to come back and strongly reiterate it. I just want to give a reminder that if you're listening to this as an audio podcast, there is a video that accompanies this. You can see yours truly. More importantly, you can see some of the exhibits I go through, and you can find that video either on the Super Spiked or Veridan websites. It's also posted to YouTube, LinkedIn, and Twitter X. And with that, let's get into the video. So you all have seen this exhibit before. It is a graph of the energy sector's market cap weighting, its S&P weighting, if you will. That's the gray line, versus its earnings weighting, the contribution that energy companies are making to overall S&P earnings, which is the blue line. And it is my friend and former colleague at Goldman Sachs, David Kostin, who had the phrase, energy tends to punch its weight in the S&P 500, meaning whatever its earnings contribution is, you would expect that to be its market cap contribution. Let's go through kind of some history about that, where we are today, and why we believe the current market cap weighting will close up towards its earnings weighting. I think the first period I want to highlight is this most recent period where, coming out of the COVID lows, where earnings were, companies were losing money, we had a really sharp recovery coming out of COVID that was then turbocharged by the start of the Russia-Ukraine war and the surge in oil prices to kind of above $100 a barrel in the early and middle part of 2022. And you saw earnings recover dramatically. And initially the stocks were moving up with earnings. And then as investors sort of sniffed out, hey, maybe this has gone too far too fast in terms of the oil price gains and the implied, or the actual, returns on capital, maybe the sector's over-earning here in the second half of 2022. You saw the market cap weighting sort of disconnect from that earnings weight. And, we've now had, it's a little over 2 years of negative EPS revisions, and therefore also a degradation in return on capital. We'll show that on the next graph. And the S&P market cap weighting has also eroded. Now, the fact that earnings revisions have been negative, that to me makes it logical that the sector has lagged. Now, we can say AI is taking off and people are just focused on the Mag 7. There are a bunch of related sort of excuses we can make, but at the fundamental level, when you see earnings sort of contract from those peak levels as much as they have, you typically don't expect stocks to outperform or even maintain performance. I think the real question is this gap we see here today between the roughly 3% market cap weighting and the 5% or so earnings weighting, is that appropriate? And let me show a couple historical examples. So we see the example from 2016-17 as well as the COVID lows, where people perceived that the sector was under-earning, and therefore the S&P weighting, the market cap weighting, did not collapse down to its earnings weighting. So 2016-17, COVID, the market cap weighting was in excess of the earnings weighting because people thought the sector was under-earning. And then in the more recent period after Russia-Ukraine, the earnings weighting was higher than the market cap because people thought the sector was over-earning. I think that should make sense. When you're over-earning, you don't get full credit. When you're under-earning, you also, in that direction, don't get full credit. I want to look at the period in 1999 to 2003, because it reminds me a lot of the mini cycle we just had, where coming out of the Asia financial crisis in 1998, we saw a surge in oil prices and earnings revisions. And again, people perceived that that surge was temporary, and you saw the earnings collapse. But if you look at it, earnings collapsed in 2002 back to the market cap weighting. And this was just before the super cycle. So I think a couple things. There was some skepticism about that, let's just call it 2001 rally. But on the other hand, when earnings normalized after a year and a half of negative earnings revisions, the sector's market cap weighting was in line with its earnings weighting. That is very different than today, where we've had a similar trend and sort of a spike up in earnings and then a spike back down, but the market cap weighting is still lagging. I think someone will say, hey, Arjun, you just said stop blaming the IEA or ESG or activists. Maybe this is an example where if people still perceive peak oil demand as a thing, or this or that net zero objective or what have you might still be out there, isn't that why there is a gap? And I'm going to say this. I am someone who believes in personal responsibility, whether that's for myself, whether that's for companies, whether that's as an analyst or what have you. It's up to companies. It's up to analysts who believe in this to make the case for their sector. And you have to win the argument. We've seen, well, let me say it this way. If you look at the IEA's peak demand forecasting, if you look at their World Energy Outlook base case view, which has a peak by 2030 and sort of a very slow erosion after that, I'm going to call that their base case, not the net zero forecasts. Their forecast is not dissimilar than just about all major oil companies. So there is no difference between how the leading companies have talked about oil demand and the IEA. So that is my point on why does everyone choose to blame the IEA when companies don't stick up for themselves? They don't articulate their own positive view on what the outlook for their sector is. Why does everyone believe Billions of people are going to voluntarily choose to stay poor. It is not up to you as an American or European, or up to me for that matter. If they want to accrue wealth, if their economies are going to improve, they're going to use more energy, including a whole bunch of oil. Why is it that all the major oil companies that publish forecasts have a very similar kind of flattish at best oil demand outlook, as does the IEA? It is not about blaming the IEA. It is about taking responsibility for your own actions, for your own articulation of your investment case. So again, there's a gap, and I'm going to get to the profitability metrics next. But at a time the sector, I think, is slightly below normal on return on capital, where I think oil prices are closer to trough. It's not exactly the deep trough that we had in 16, 17, or 2021. The market cap weighting, in my view, should be in line with earnings weighting like we saw in that prior period in 2001 to 2003. So I want to now show where we are on profitability for the sector. So let me explain the graph first. The black line is the real oil price in 2024 dollars, graphed on the left axis, dollars per barrel. The dotted lines for both metrics are rolling 5-year averages. And then the green line is cash return on cash invested, the CROCI metric. The ROC graph, just so you know, it is very similar, just the right axis, the numbers would be a little different. I don't like the write-offs. I think the cash and cash returns works better for the purposes of this. The conclusion is very similar. So I think a couple things we'd highlight. First, in terms of oil prices, we think we are currently at or near what we're going to call a normal trough, not a deep trough like COVID, or not the kind of deep trough we had after the end of the super cycle in 2015 and 16, the crash therefrom, but I'm going to call it just a normal trough. Could we be too optimistic? Of course. We'll give 1,000 caveats, recession arrives, what have you. We are pushing back on the oil glut narrative. We accept there is some modest oversupply. We believe I'm going to call it a normal cyclical trough is what we're looking at and where we think we are. And in real terms, we think we're plus or minus there with oil in the low 60s. And I want to contrast it to the profitability metrics. And you can see the deep trough in profitability we had in 2016 and 2020. And that'll be the pushback. Hey, Arjun, you're saying we're closer to a trough return. We're way above a trough return. Those were deep troughs coming at the end of a super cycle, where you'd had a bunch of capital and overinvestment in 2010 to 2015, all the projects, all the cost inflation, pre any restructuring, pre any cost cutting. Returns they are what they are. They were depressed returns where the oil price crashed to very low levels at a time where CapEx had been high and overinvestment had been high. That is not where we are today. Companies have restructured. Companies are cutting costs now. Look at all the aggressive cost-cutting measures we're seeing before we're at a deep trough. And it has surprised me. The industry has done a much better job of getting its act together on a profitability metric basis. We are below the 5-year average on cash returns. We are below normal. And yes, we're way above these trough levels. In my opinion, no one should be expecting us to get back to those trough level of returns. We can be wrong that it's just going to be a kind of a normal low in oil price and we're already there. We can be wrong about that. I'm going to say, I do not believe we should be expecting 5% CROCIs to come up anytime soon. So on that basis, I think we are below normal and much closer to the low end of the range, which sets up for a much better risk reward. Let me put another set of circles here, because this is the last period. First is the mini cycle. Well, we think this period is most like, and you can see the kind of deep trough we had in the Asia financial crisis was actually a better return on capital than we did have at the end of the super cycle. Remember, the super cycle in the 80s ended in 1986. So by the time you got to 1998, you'd had a lot of cost cutting and restructuring and asset sales and all these kind of things. And the kind of trough in what was a deep oil price downturn in 1998 resulted in, frankly, that was a deep downturn. The kind of CROCIs we're sort of seeing right now. They were a little worse then. And then, of course, in the 02 downdraft, in that mini cycle, the CROCI is very similar today. Again, a trough level return. And then, of course, we had the super cycle to follow. We're going to comment on whether we think a super cycle is coming next or not. My point is that I believe we're closer to the low end of the range in returns. And therefore, if you go back to that previous graph, people should not be discounting the market cap weighting of energy in the S&P 500 to its earnings weighting as if the sector was over-earning. It is not over-earning. And therefore, those two lines should be much closer together. I'm not going to blame the IEA for that. I'm not going to blame AI tech enthusiasm for that. I'm going to say companies and analysts have to stick up for themselves and articulate the case for why investors should come back to your companies. And it's not about appeasement. And it's not about saying, well, in a flattish demand environment, we're still going to do okay. Nonsense. Stick up for yourselves. The world is not going to stay poor. The billions of people out there deserve energy wealth. They deserve an abundance of energy, and you are the companies to provide it. Stick up for yourselves. Project positive demand because that is the outlook. Okay, sorry. The final point I want to make on this graph is that I think we are more in a period like this 2000s where where the green dotted line, if you will, is going to be trending higher. We begin legitimate debate on sort of oil super cycle or not. And so it may not be as steep as that period if we don't have a super cycle. But I think we're in year 4 or 5 of a period of structurally better returns. That is also the basis for believing we are below normal right now in the context of a structural upturn. And remember, most analysts and portfolio managers, especially those who are much younger than me, they've only lived through the 10-year downturn. That is what it is. These cycles are 10 to 15 years up, 10 to 15 years down. Almost every portfolio manager out there has only lived through that kind of 10 to 15 year down and then a brief COVID recovery, Russia spike mini cycle. And they're treating it as a one-off, all while everyone, including the major oil companies, are saying oil demand is going to be flattish for some reason, especially by 2030. I think we're at the start. I think we're a few years into a structurally better period for profitability, and I believe it's on track to play out. So let me just give a handful of oil macro thoughts. The first thing I want to address is, Arjun, why are you spending so much time on oil? You know, there is an AI story that impacts energy. Obviously, data center growth means a lot of power demand. That impacts positively the natural gas sector. It impacts positively nuclear. You can talk about new technologies like geothermal. You can talk about solar and batteries, which at least you, Arjun, have a favorable view of. We can debate the economics of wind and some other things if we want to, but a whole bunch of things in terms of power generation that we could talk about. I think that story is a good one, at least in traditional energy, that positively impacts the natural gas space. And as we've said, we believe countries will be incented to use new technologies. And so we continue to evaluate for which regions, which technologies make sense and how are they going to scale up. The reason we spend so much talking about oil is because that to me is where the disconnect is. I think people are just way too bearish about the near and long-term outlook. I don't believe in the oil glut narrative. I don't believe in peak oil demand. I believe the other billions of people on Earth are going to want to gain energy abundance and economic abundance, and oil is going to be a big part of that. And probably as someone who's spent his career in the traditional energy sector, there is some sort of value orientation as opposed to a momentum and growth orientation. And oil to me is really jumping out as both a commodity and a sector that has been really out of favor and looks really interesting right now. So a couple points here. First, we're going to declare demand is solid. It's not booming, but that it is solid, and that the absolute and the growth rates are closer to OPEC research than they are to IEA figures. We spent a lot of time on the last month. That is our outlook. Refinery runs and refining margins are consistent with that OPEC research view of demand. They're actually doing just fine. Are they booming? Perhaps not, but I'll take this level of both refinery runs and margins every day. We've noticed that China is stockpiling, has replaced OPEC's teaching Kazakhstan a lesson as kind of the ridiculous narrative of the day or the excuse of the day. It's not that China is not building its SPR, it clearly is. But the idea that somehow doesn't count, and we would have an oil glut if it weren't for those pesky Chinese SPR buyers. I think people need to re-examine their views. And remember, Chinese inventories actually drew in the first quarter before building in the second quarter. And we're not going to go through the whole why is China building its SPR. I thought they were having peak demand, right? Didn't they no longer care about oil? But let's save the sarcasm and say that's a lame excuse. It's a lame excuse for the oil glut. It is not showing up in refining margins. It's not showing up in refinery runs. Yes, China is building its SPR. It makes strategic sense, in my opinion. The OPEC quota cut unwind is revealing that I think many people out there, many oil observers, have been overestimating OPEC spare capacity. A lot of people, in my opinion, were taking the announced quota reductions and adding them up and plus or minus getting to that's how much OPEC spare capacity there is. There certainly was some spare capacity built up, and that is now being unwound. But I think it's limited, and we've always thought it's limited, to basically Saudi Arabia, United Arab Emirates, Kuwait, and perhaps to some degree Iraq. It's basically in those four countries. I think those four countries are back to being in control of how they think about, if they want to, managing oil supply, perhaps meeting China's demand for SPR needs, meeting demand in the rest of the world. I think they're in a good position right now, but there's been a general overestimation of OPEC spare capacity. We want to start mentioning the concept of crude oil as a store of value, perhaps amongst the reasons China is building its SPR. In a world where there have been a whole bunch of economic sanctions, including on dollar reserves, when there's questions about the US dollar, when there's questions about too much US government debt, when there's questions about our budget deficit and fiscal balances, it is not crazy that people have been buying gold. It is not crazy that we've seen other commodities do well, yet oil has stood out on the negative side because of these concerns about peak demand or oil gluts or what have you. And I'm going to say at today's prices, when I think we're at or near a normal trough, I'm going to call crude oil an inexpensive store of value. It probably deserves more of its own analysis and discussion than a one-liner here. But I think both for the commodity itself and for companies with oil reserves, they're a store of value, and that has not been reflected. It certainly is not reflected when you see the S&P market cap weighting for energy is well below its earnings weighting. And I want to add, because I don't want to leave it out, there is also considerable value in both midstream and downstream assets, which I think are still underappreciated. On the supply side, I want to make a trio of comments. First, on US shale oil. This is the one part of the kind of the oil price bull argument that I do push back on a bit. I'm going to call US shale oil price sensitive. So if oil's below 60, I think we'll get some declines. If companies and investors believe for some reason oil was $75 or higher and it was going to stay there for whatever reasons you want to make up, I think in that kind of environment, you will see shale oil grow again. It is a massive resource. I am not a geologist or an engineer, but I am an analyst who studied this sector. And my observation is when you got giant oil fields and the recovery rates are currently quite low, in many cases, single digit or maybe just above that, there's a lot of scope to apply engineering and technology going forward. Now, that doesn't mean it happens automatically the first time oil ticks up above $75 a barrel. It might take a technology cycle. It might take a price cycle, meaning going well above $75 a barrel to motivate figuring things out. But these are franchise assets. If you are a company that owns or exposed to US shale oil, and for that matter, shale gas, it is a franchise asset that the market is currently saying we're not even going to give you credit for your current earnings contribution to the S&P 500. I think that's a really interesting opportunity. I have a colleague at Veriton, Gabe Collins. He is full-time at Rice as part of the Baker Institute. He's part-time with us. He is a geopolitical and Russia expert, and he's done some terrific analysis on the Russian oil industry and its companies. I apologize, that work has been more for Veriton clients, but I'm going to give just the big picture takeaways, which is Russia is certainly, like the US, blessed with a lot of favorable geology, but at a time that they have been now in a war situation for about 3 years, the companies and the industry is increasingly capital starved, and there is a need both to apply new technology and to have their own CapEx and maybe fiscal relief cycle that, at least so far, is not on track to happen. And therefore, with all those points made, Russian oil production is looking quite mature. And I have to give my credit to Gabe Collins for some excellent work there. You can follow him on LinkedIn. He often comments there. The other thing I think we want to observe is that drones are now a thing, probably for the world at large, but including oil and refining capacity. And I actually have to give Gabe credit again. We were talking about economic sanctions. He's like, hey man, those have really not worked But what is working is physical sanctions. I love the line physical sanctions. And so drone strikes by Ukraine on Russian refineries in particular, but also perhaps on some oil infrastructure, you are starting to see this impact the supply-demand balances. I think that deserves much more of its own discussions. How do we think about whether that is worth a risk premium or not? You can debate some of that, but I think all of that is something that we now have to factor in terms of how we think about kind of the value of crude, especially the value of crude in favorable places like the United States and Canada. It must be worth more. The final point I want to make on macro thoughts is just really how we think about tail risks. So we have said consistently that we believe we are in a super volatility crude oil macro environment, not, at least not yet, an oil super cycle environment. And in fact, we feel some pride that at the peak of Russia-Ukraine, when a lot of the same analysts who are very bearish now were super bullish back then, when oil was $100 a barrel, we pushed back, or we did not agree that we were in an oil super cycle. We said super vol. I think the question though is, how do we think about pricing risks in? And relative to a base case range, let's just call it $60 to $80 base case range for oil in real terms. We're going to say there is more risk of an oil super cycle than there is of a structural bear market. And I think the street's been inverted on that. I think a lot of people agree on sort of that 60 to 80 range, but some of the discount you're seeing in the market cap weighting today versus the earnings weighting is that people are saying, I think it's more likely we could have a structural bear market because China's mature and there's going to be peak oil demand, and aren't we going to grind higher in shale, and OPEC still can raise production. For all those reasons, it's not just near-term oil glut. People have been placing higher odds on structural bear market than they have on super cycle. I think you need to do the opposite. I think the risk is higher that we have a super cycle to the upside than it is that we have a bear market. We're not going to give percentages here, either publicly or at least right now at this moment. That's just how we're thinking about how you would skew risk reward relative to that base case $60 to $80 range. I think the final area we want to talk about are just some similarities and dissimilarities with that previous mini cycle from sort of 99 to 2002, which immediately preceded the 04 to 08 most meaningful period of these, what we call the super spike era, the namesake of this publication, but that super cycle. Let me start with some similarities. I think first, there is today, just as there was back then, end of oil narratives. There's the famous 1998 Economist cover, Drowning in Oil, which came out basically at the bottom of oil prices. And then just a few years later, another Economist cover that talked about the end of the oil age. And I've showed those magazine covers in a while ago, a prior issue of Super Spike, but that was the mindset. And a large part of it was the maturing of what had been some of the leading growth drivers. After the Asia crisis, people said, hey, the Asia tigers, they're mature, and the tiger cubs as well. And these are countries like Singapore and South Korea and Hong Kong and Thailand and so forth. And they're just not going to grow as fast. And Western Europe and Japan are maturing and so forth. And so a lot of pessimism back then, different reasons than today. Today, it's more this sort of climate net zero kind of talk. But for whatever, there was end of oil narratives abounding back then. And believe it or not, back then, there was also a huge enthusiasm for the tech sector. So I launched coverage at Goldman Sachs on December 7th, 1999. And the title of our launch report was Vying for Attention in an Internet World. It was turned to be a huge bubble in the internet sector. And now we have a lot of AI enthusiasm. Now, we don't have the pets.coms today, right? So the leading technology companies, they have phenomenal growth, phenomenal actual returns on capital and free cash flow. So there are similarities and dissimilarities with that previous period. And at Super Spike, at Verdin, we have a positive and enthusiastic view about artificial intelligence, digital transformation, and all these kind of cool topics to talk about. However, the sort of all we should care about is tech. We definitely don't need to care about energy. It feels a lot today like it did back then. So we are vying for attention in an AI kind of world today as a traditional energy analyst, and certainly anyone in the oil sector. Now, what is not similar with that prior period, at least not yet? We don't have a China equivalent global GDP accelerator. Now, we are positive on India oil demand, rest of Southeast Asia, increasingly African demand from all the countries there, Middle East and Latin America. And I think all of that does add up to continued and non-trivial oil demand growth going forward. But of course, we didn't have the China GDP booster until the super supply cycle really started in kind of the 04, 05 timeframe. So we'll see if it happens this time. But instead of like 1 million barrels a day of oil demand growth, can you get back to 1.5 million plus? That can make a big difference in terms of declaring or believing we're in a super cycle as opposed to simply kind of a range-bound price, even if we think the range is a little higher than today. I think the other thing we don't have today is actual supply disappointments. So we might critique some of the estimates on OPEC spare capacity or what various plays can do, but it was our first top projects report. It was either 2002 or 2003. Michele Della Vigna, who spearheads the report today and has now for quite some time, he was actually a junior analyst, and he's the one who did most of the hard work back on that initial report. So it's always been his baby. He deserves a lot of credit, full credit, for that publication. But those initial reports at Goldman Sachs, we were forecasting robust non-OPEC growth. And after 2 years of disappointments, we did some work to say, hey, wait a minute, there's something else going on. Supply was visibly disappointing. And we don't have that yet either. And so we'll continue to stick with this super vol language. We believe we're closer to the low end of the range. We believe returns on capital are under earning for the sector and that the S&P weight's too discounted. We think a super cycle is more likely than a structural bear market, but we are not declaring, and we're not trying to be cute about it. You got to believe in an acceleration in demand and actual supply disappointment. So I think truly move into super cycle kind of mode. So I'll end this video on a personal note, and we want to continue our theme of mental health awareness, touching grass part 2. We noted it last week. It was the Utah governor who said, get offline, stop getting mired in all the sort of highly politicized comments, the American culture wars, all that kind of stuff you find online. Log off, actually live in the real world and physically touch grass. We give 2 examples of that. I will say, do it after finishing this video if that's okay. So this is the one thing that is okay to be online for. Super spiked and Veritin content, totally okay, but otherwise log off. The first is, and we've mentioned, this past summer, summer's now over, it's the fall, was the summer of sort of adjustment for my parents. They lived on Cape Cod, which is about 6+ hours on during a good time away from us. And they've generally had very good health. We're going to knock on wood. As they've gotten older, some challenges in the past year, and it caused them to move. They were living with us, my father for 3 months, my mother for 2 months. It really is very illuminating to live with your parents. Last time I lived with them, I was 19. I'm 56 now. It is very different living with your parents as an adult with now grown children than it was when you were the child and they were your parents, and it had been kind of a continuous thing since birth. Very different. But it has been fantastic. And what is really great about, they now live 10 minutes from us. They're settled in there. The health is I think, as good as you can be expected at their mid-80s kind of age. They're doing well. But what's great is we see them all the time now, and it's just kind of normal stuff. So when you think about it previously, when they were 6 hours away, you'd see them Christmas, Thanksgiving, maybe once over the summer, maybe one other time during the year. But every time a Christmas or Thanksgiving would come up, you would do the morbid actuarial table of what's the over-under on remaining visits. And can I count it on one hand or 2 hands or more than that or less than that? Now we go over for a cup of tea. They come over here for dinner. We go to their place for dinner. Kids are coming home this weekend, after some work stuff. They'll stop by, so like now we're beyond worrying about counting visits. It feels infinite. We don't take it for granted, but I will say having them live 10 minutes away, it's been a real silver lining to the health scares they went through. You don't want them to go through health scares, but if it means we've now shifted from a world where we could count on only a few hands how many remaining times we'd see them in the rest of our life, now we don't worry about that. We're going to see them a ton, and for as many times as we're meant to see them, it has been a real silver lining of the challenges they went through, especially this spring. I think the other thing I want to highlight is, as we're spending more time in Houston, and we're not just touching grass, we also have to maintain our physical health. My wife's not always going to be there. I got to learn to cook for myself. So that's me grilling. Now, I was with Maynard and Jeff this week, my colleagues at Veritin. I showed them this picture of like, dude, you're grilling, who cares? Let me just say, it is a big deal. So for those first 19 years of my life, my mom cooked dinner and every meal all the time. It was awesome. She's a great cook. And even I went to college in Denver. They were in Albuquerque. she would freeze about 3 months worth of dinners. And that was also my dinner, therefore, all through college, all through the college years. And it was only that sort of dark period when I moved back to New York before I got married, where it was 6 years of Stouffer's French bread pizzas, Hamburger Helper, pizza pockets, and going out to dinner in New York City. Not a good diet by any stretch. As you get older, the metabolism slows down. You have to start eating better, and that means cooking real food, not processed food, and that is what we have learned to do. My wife is teaching me how to cook. I can't say I'm super excited about it, really. And so for the past 25 years of marriage, she's cooked every meal. She's a fantastic cook. I'm very appreciative. But if I'm going to be in Houston, sometimes on my own, I got to learn to cook for myself. And this was the outcome. Now, again, Jeff and Maynard saw that. I don't think they were actually as impressed as they thought they would be. I don't know why. But that is a salmon with avocado. It's mushrooms and asparagus. I could frankly eat that almost every night. And based on my history with the pizza pockets, maybe I will. But I think that turned out beautifully and it tasted good. Now, the fancy sriracha mustard kind of presentation, my wife does deserve credit for that, but I'm learning how to cook. We're not just going to touch grass and focus on mental health. We're also going to focus on physical health. And if I'm fortunate enough to live as long as my parents, I want to be functional. I want to be healthy. Thank you.